railroad from the East Coast to the California, so become from the East Coast to the West Coast throughout the whole United States. And by 1890, there were about 260,000 kilometers of railroads in the US being built. So you can see the huge jump of railroads. So actually that was, at the time, it was the largest industry in the US, apart from agriculture. So they employed the most amount of people also. So the map, the bottom right map is actually the railroad network map in 1890. So then the second part of railroad industry, which is the peak, it was that there was so much building that a lot of loose financing took place. So you could say that was the bubble at the time. So everyone had a railroad, everyone built railroads, start railroad companies. So banks were also lending very loosely. So in the oversupply of railroads caused the panic of 1893, and the panic actually caused about 25% of railroads to be shut down because a lot of banks failed and railroad companies also failed. So about 64,000 of kilometers of railroads actually were decommissioned, and there was a wave of consolidations. So about 2/3 of railroads were controlled by 7 entities. And so the New York Central and Pennsylvania Railroad and JP Morgan, these 3 entities actually own the largest share of the railroads in the US. So actually that resulted in those robber barons at the time. The bottom 3 were like JP Morgan himself on the left, Cornelius Vanderbilt, and Jay Gould. These 3 are like the robber barons at the time. So in today's dollars, they're actually billionaires at the time. But at the time, the wealth is much, much more because some of them can have a certain percentage of the total US GDP. So they're actually really much, much richer in relative terms compared to the current billionaires. And because of this monopolistic behaviors, in 1887, the Congress set up the ICC, or Interstate Commerce Commission, so to regulate the industry and prevent the monopolistic behavior. And by 1916, actually, so much development of the railroads happened that it was about 400,000 kilometers of railroad in the US, and they employ about 1.7 million workers. So the bottom right chart is the amount of railroads in the US in 1916. So this was actually the peak of the whole industry, and the amount of railroads used will never ever hit that level again. And then begin the third time period, which is the decline of the railroad. So in World War I, the US government actually nationalized a lot of the railroads because it was the main means of transportation, especially across the whole country. So they used it to transport weapons and machinery and everything. And they also passed a bill to restrict the railroads to charge unfair rates. So the government determined how much rates the railroads can charge. And in the 1920s, the Ford Model T was actually went into mass production at the time. So automobiles became an alternative form of transport other than rails for intercity transport. So that actually caused a huge decline in rail passenger volumes. But that seen a rebound during World War II because automobiles were sort of parked at home, they don't really drive. So the main intercity transport volumes came back up and rebounded. But it was short-lived because after the World War II, basically President Eisenhower commissioned to build the interstate highway system. So those actually proliferated the automobiles. And also there was the airplane Boeing 707. So basically air travel became another alternative to rail transport between states and cities. And by the 1960s, many passenger railroads actually basically exited or went bankrupt. But freight railroads also face strong competition from trucking because of the highways. And especially in the East and Midwest, because the cities there's shorter distances between the cities. So that actually poses a lot of competition and cause a lot of bankruptcies in the railways, especially the passenger railroads in the East and Midwest. So amidst declining profitability across the industry, the ICC also, since they had the power to determine rates, they limited the ability of railroads to raise rates to sort of counter their increased costs. And they also couldn't eliminate those unprofitable routes because the regulation will force them to operate routes and they cannot close down the routes that were not profitable. And in the 1960s, a lot of railroads have merged because they thought that they could merge and reduce costs and realize efficiencies. So one example would be like the Erie Lackawanna and the Northwestern Railroad. Yeah, so then one of the big event that I thought was interesting to bring up is the Penn Central bankruptcy. So I think people who have brought it up like once in a while, sometimes you see it in the news on this term. So it's interesting because it was the largest bankruptcy at the time in the US. And it was significant because it was the sixth largest company in the US at the time, and it just went bankrupt. So it was Exxon background actually formed in 1968 with a merger of Pennsylvania Railroad and New York Central System and another smaller railroad. And they faced many problems in integrating the merger. So there were many conflicts of culture and also a lot of efficiencies that they thought they could realize, but they couldn't. They tried to diversify into like real estate or non-railroad ventures, but that was really unsuccessful. And one key thing is that the management actually insisted on maintaining their dividends. So they were losing money, a lot of money every year, but they still took on debt to just pay the dividends. And they funded their operations heavily using commercial paper. So this is important because as their debt level increases, the commercial paper interest rates are also higher. So they basically have to fund their operations with higher and higher interest rates. So basically it's a downward spiral. So how bad was it? They lost about $2.8 million in 1968. By 1970, they lost about $325 million. So they filed for bankruptcy in June 1970. At first, three weeks before the bankruptcy, the government actually wanted to loan them $200 million. Or actually, President Nixon wanted to loan them $200 million. But he faced a lot of backlash from Congress. So basically, he pulled back the loan and they were forced to file bankruptcy. So as I mentioned, it was the largest in US history, other than Enron, which happened in the year 2001, I think. So this impacted the economy greatly because they had a lot of jobs, especially in the railroad industry. But the bankruptcy was actually very complex because they had a very complicated corporate structure, and it took 8 years just to settle the whole bankruptcy. And the government ended up taking over most of the properties and operations. So this was the headline of the New York Times then. This is actually a bankrupt stock certificate, which is quite interesting. Yeah, this was their train. So after that bankruptcy, Congress actually felt that they need to do something to save the railroad. So they formed the National Railroad Passenger Corporation, or also known as Amtrak. I think if you live in the US, you probably heard of it. So Amtrak actually received taxpayer funding to assume operations of some of the routes or railroads that went bankrupt. And they reduced, because they had government funding and the backing, so they managed to reduce their routes in operation by half and streamline its operation, but it still loss-making until today. But many believe that it was just going to be another failed venture by the government. But actually, it proved to be wrong. So since the 1970s until now, the passenger volumes have been increasing quite steadily, other than this drop, which is COVID. But I think Amtrak is the only passenger railroad now in the US. Yeah, at least the major one. And then also, because of the Penn Central bankruptcy, Congress actually enacted the 4R Act, or the Railroad Revitalization and Regulatory Reform Act. So they took some steps to deregulate the industry, and they also created Consolidated Rail Company, or Conrail for short. So Conrail was created by the government to take over like potentially profitable routes, and of those bankrupt, like mainly they took over a lot of Penn Central's routes. So they received funds from the government. So the government ended up owning 85% and employees own 15% of Conrail. But they still remain quite unprofitable until the Staggers Act, which I'll talk about in the next slide. The Staggers Act is one of the most important laws that came into place that loosened regulations. So after that, Conrail turned a profit in 1983, and in 1997, it was actually privatized by CSX and Norfolk Southern. So these are two of the 7 large railroads in the US. So they took over Conrail, they split up the assets. I think it's a 50-50 58-42 split. I think not CSX took more of the railroads, of the routes. So in the end, they split it up and they operated under them. So basically Conrail was dissolved. So the main event, which is the Staggers Act, as I mentioned, is one of the landmark events that deregulated the industry. So after the 4R Act, Congress also felt that they needed more deregulation. So they enacted the Staggers Act. So the Staggers Act mainly removed most of the regulatory restraints. So they allow the industry to adjust their rates with more flexibility and also tailor more services to meet the shipper demands. And also they can set what clients they want and what they don't want. Previously, they couldn't. They had to just take what they have. And they also allowed to restructure their systems, cut those routes that are unprofitable or not efficient, which previously they couldn't. So this actually helped to control costs and allow more investment to flow into the industry. The Staggers Act also basically walked back the control that the ICC had. Now the ICC became the Surface Transportation Board, which still exists today to mainly regulate the railroad. But they basically limited their authority to regulate the rates for uncompetitive routes. So basically last time the ICC could regulate the rates, but now the STB basically have no say on the rates. So it's basically the government loosening on the control. And half of the traffic actually is exempt from regulation. But some routes are still subject to regulation, about 20%, because they are basically some of them, there are only 2 operators in a certain place. So they don't want to prevent monopolistic behavior. They also legalized contracts. So railroad and shipper contracts weren't allowed until the Staggers Act. So now they can have a private contract among 2 parties and have a determined rate on the contract. Previously, they had to disclose all the rates that they were taking every year. So that make it the removal of the regulation actually helped the industry to become more competitive. And one interesting thing is, if you look at the bottom right chart, so since then, the prices actually came down because the industry is so much more competitive that they managed to make their prices lower, but how they did it is they increased their productivity, so they cut the costs and everything. So revenue went up, but volume stayed about the same. So this is actually very important because the productivity was very bad and nobody made money in the railroad industry. I will show the historical returns at the time. So basically it was a dead industry for maybe 100 years until this Staggers Act came about. So after Staggers Act in 1980s, there was a huge consolidation wave. So on the left, these are the big 5 US-based railroads. They call it Class 1 railroads. I'll talk about what the different classes later. So BNSF, as you know, is owned by Warren Buffett's Berkshire Hathaway. So he bought it in 2010. Yeah, so it was basically they consolidated a lot of railroads, small regional ones to become the large ones. Union Pacific also consolidated a lot of the smaller ones. I think the smallest one is the Kansas City Southern. They just got bought by Canadian Pacific, which is another Class 1 railroad. So I'll talk about what Class 1 is. So this slide is just to tell you that actually a lot of consolidation. Now there are only 7 major railroads in the US. And in the 1800s to 1900s, there were like thousands. So you can know how far the industry has come. And it actually, on a side note, it's actually quite similar to what happened to the airline industry. So the deregulation of the railroad industry came very near to the airline industry deregulation. So currently the map of the top 7, these are the rail lines. So you can see BNSF and Union Pacific mainly service the west side of the US. And the CSX, Kansas City Southern and Norfolk Southern is the East Coast. So the East Coast mainly is CSX and Norfolk Southern. So Canadian National is the north to south one. Kansas City is a smaller railroad. It's only around here. And they also link to Mexico. And Canadian Pacific also mainly take the north part. So the largest 2, if you guessed it, is probably BNSF and Union Pacific. So they are the largest railroads. by revenues, the largest two. So what are what type of railroads are there? These are the federal classifications. So according to the government, the class one is actually the largest rail carriers in the US. So it's based on revenue level. So as of 2020, class one are revenue carriers with more than $900 million in revenues. So this revenue threshold changes every year. So I think in the early 1900s, it was only maybe 1 million. So now it's 900 million. So there are only 7 class one freight railroads in the US. If you include passenger, Amtrak is another class one. But mainly the listed ones are all freight railroads. So there are 2 US based, which is Kansas City, Union Pacific, CSX, Norfolk Southern, and BNSF. So the 2 Canadian ones are Canadian Pacific and Canadian National. So class 2 are more of the regional ones. So they have 40 million revenues to $900 million in revenues. And they mainly carry freight in regions and also from those, let's say, coal mining, and from the mine to the main track. And then they'll pass on the freight to the larger players, which have more access to the other parts of the US. Class 3 are any carriers below these two. And I couldn't find any class 3. So that's how, how you know it's really very few class 3. So the consolidation is really there. So these are really the main ones there. And class 1s are the ones that mainly people are looking at class 1s. So currently the competitive landscape is quite oligopolistic in nature since there are only 7 class 1 freight railroads. So by market cap, the Union Pacific is the largest and followed by the 2 Canadian ones. So CP will be larger because they bought KCS last year, but the merger hasn't closed yet. They are waiting for regulatory approval. So BNSF is bought by Berkshire Hathaway in 2010, I think at a $29 billion. So I think if it's listed today, it definitely will be worth about at UNP's price or maybe even higher. Yeah. And why I brought in on the right, top right, is the enterprise value. I brought in enterprise value because the industry actually weirdly is similar to the utilities industry. So they actually require you to take on some debt because debt is cheaper than equity. So since it's a regulated industry, they will require you to take on some debt to sort of optimize your capital structure. Yeah. So that's why most of these railroads have actually some debt. So that's something interesting because, yeah, I think like generally you feel that have less debt is better, but in this case, the government actually made them take on debt. So, and also one fact is that they have actually yearly cost of capital calculation. So the government will actually make sure that the railroad is profitable or earning more than its cost of capital. So that to ensure that the railroads at least have viability, which is something interesting. So basically the government gives you a license to print money. In another way, utilities is the same. It's just that returns are not that good because they might set a ceiling of how much you can earn. So you won't earn very high returns, but you probably won't earn below cost of capital. In 2021, by revenues, BNSF is the largest, followed by Union Pacific. So it's actually quite similar to the market cap. So CP and KCS, you can just add those 2 revenues up because they just bought. But you realize that the Canadian ones, the market cap are higher than this CSX and Norfolk Southern, while revenues are lower. So that one is because of the valuations, yeah, which I'll show you later. And in terms of operating profit, similarly, UNP is actually more profitable, the Union Pacific, compared to BNSF. Yeah. So this is something interesting that the margins are better for Union Pacific. So I'll talk through some characteristics of the railroad industry. So I mentioned it's quite oligopolistic in nature because basically the consolidation made the railroad industry that since there are only 7 and some regions, like I mentioned, the west side of the United States, there's only Union Pacific and BNSF. So in those regions, there are only 2 main railroads that you can choose if you are a shipper. So that actually is a duopoly. So basically, that's really if you really 2 of the railroads can actually control the price in those areas. So there's actually some regulation pushback recently by Biden saying that the freight carriers are actually engaging in monopolistic behavior. They are sort of controlling prices, but I don't think that's true. I mean, their profitability has improved, but I think still because their main competition is with trucking, which I'll talk about later. So yeah, but they have a very strong moat because there's the barriers to entry are basically unsurmountable in my opinion. Because it's not possible to just build new rails. You need so much capital and you need a lot of capital to build new rails, get all your new customers. It's just not possible. And I don't foresee any class one railroad being entering the market anytime soon or even in the foreseeable future. It's very unlikely. So that's good because since the market, there are only 7 players and each players have their own regions, it's quite like their revenues and earnings are quite visible in the near future. So that's actually one good part that you will definitely get some good return or some return on your investments in this industry. But it's very capital intensive. So on average, over the past 30, 40 years, the railroad industry has invested about $20 billion a year just on maintenance of their rails. And some of their rails are built 100 years ago. So they might need to rebuild them or maintain or even buy new equipment, buy new buy new rail cars and stuff. So it's very capital intensive and they have to reinvest a lot every year. However, I mentioned they get decent returns because it's almost a certainty that they will be profitable because there's no other competition other than trucking, but within the railroad industry, it's basically a license to print money. But one downside is that it's cyclical. So the demand really is highly correlated to the economy generally. So in recessions, revenues will drop and in recoveries, the revenue will increase. So it's similar to the auto industry, but it's less volatile than the auto industry, but still it's quite cyclical in nature. So if you ask me as an investment, it's unlikely a very long-term hold because it's the cyclical nature of it. But if you get in the right time and get at the right time, it's probably a good investment. And I mentioned it's a very old industry, so the workforce is heavily unionized. So that will bring actually cost pressure to their labor because the unions have union contracts, they have to have at least some fixed increment every year for their staff. And also, especially during inflationary periods, that will be higher cost pressure because most of these union contracts are inflation based. And there's also, because of the old industry nature, there's a lot of unfunded pension liabilities. So that might have a drag on profitability if they have to allocate more of their profits to fund the unfunded pension liabilities, depend on their return assumptions in the future. But yeah, so these are unique characteristics to the old industries like autos and railroads, especially the pension part. And also slow growth. So their revenues actually grow largely in line with the economy. And it's unlikely that railroads will grow much faster in the future. It's just a slow growing industry. So they have to rely a lot on efficiencies and cutting operating leverage to drive their earnings growth. So on the left is the cost structure. So typically a railroad has a few costs. The largest cost would be the compensation and benefits. So it's mainly the staff cost, employee cost, and also the pension benefits that they have to contribute. The second would be purchase services. Some are low, some are high. These are actually just some services that purchase maybe for other freight or their operations. And fuel is one of the high costs. So, and especially currently where oil prices are high, their fuel costs definitely will increase. So some are quite volatile. So for KCS, I think there's some merger costs inside. So all the players classify it quite differently, but broadly the 2 largest or 3 largest costs are classified the same, which is compensation, purchase services, and fuel. DNA is also considered within their operating expenses, and it's actually a quite large portion. So since I mentioned it's a capital intensive industry, right? So DNA actually is a huge portion of their cost. So on the right, you can see the free cash, the capex as a percentage of revenue is about 14%, some are 19%, 7%. So it's above 10%, which is very high compared to those other industries that are less capital intensive. And the free cash flow margin is not as high also. So it's only 25%, 28%, about 20% range. So that's a free cash flow margin is free cash flow divided by revenues. So you see that it's not that high compared to many other industries, especially if you look at software and stuff. But of course, if you compare to other capital intensive industries, broadly it's about the same. So these are the historical returns for these 5 companies. So KCS, I took it out because they already delisted because of the merger. BNSF also was bought in 2010. But this is from the year 2000. So you can see they more or less got flat returns until the end of about 2009, when the great financial crisis happened. But they saw a huge increase since then because of the economic recovery. And so Warren Buffett is quite a genius when he bought in 2010. So he bought it just at the recovery. So those who sold BNSF at the time probably didn't really get a good deal. It was part cash, part stock. So those who got cash stock probably did well because of the Berkshire Hathaway stock. But those who got cash, unless they redeployed, they got a bad deal. Yeah, not a good deal. And I think BNSF would probably follow this trajectory. So you realize that most of these players trade quite in line with each other. And some disparities are mainly due to valuations. So as I mentioned, their revenues actually grew only largely in line with GDP. So since the year 2000, their CAGR is 3.5%. I think generally investors won't even be looking at these industries because of the slow revenue growth. Yeah, so it's a very slow growing industry, but definitely will grow alongside the economy. So these basically the total revenues of the 7 Class 1 freight railroads. So you doubled in about 21 years. It's not that awesome. But one thing is that their profitability actually increased dramatically since then. So this one I went back longer, since 1989. So after the Staggers Act, they had to work out the industry and it slowly developed. So you can see net income margins were single digits and currently it's about high 20s. The normally in 2017 is because of the tax cut. And because they are own industry, they created our jobs, they got a lot of tax rebates, the Trump tax cut. But other than that, it's still on an upward trajectory. So operating EBIT margins and net income margins have been increasing quite steadily. So the returns and operating leverage is really improving in this industry since the Staggers Act. And also, apart from that, the returns have been getting better. But if you realize the ROA has increased from slightly above 4% to maybe about 6% now. And the ROIC has largely stayed flat since 1990s, but the ROE has been increasing. So this can only mean one thing, right? Basically, they took on much more leverage. So they took on leverage to drive their ROE. But I think if as an investor, the ROE is what matters to you as an equity holder. So you see ROE has improved quite dramatically since the 1990s. So that's why there's always increasing investments. So as I mentioned, when they invest, they'll get a decent return, but not too good return. So if you use ROIC as a metric, then you'll get an 8 to 10% return. But it's not like fantastic returns, but it has been quite stable across the years. So it's not a shoot for the moon kind of thing. It's just a steady industry. So valuations historically has also been quite range bound. So this one started this is a 10-year historical. So probably 2012. So that was just the beginning, like the recovery. So valuations were lower. Then like currently it's about the 20 range. The Canadian ones are trading at a premium compared to the US ones. BNSF is not here. Kansas City Southern delisted, I think, in September 2021. but they were trading at a premium at the time. But this jump is because of the acquisition. So basically, the acquisition price pushed that up, and they remain listed for a while. But I think largely it trades at about 2015 to 20 range. So currently, the US freight rail network operates about 220,000 kilometers. So you can, if you remember just now I mentioned at the peak, it was at 400,000 kilometers. So now they basically don't operate half of the tracks in the US because there's not that much volume to run and not profitable. But it's still very important industry because it moves about 1/3 of all US exports and about 40% of long distance freight volume. So the industry has moved from mainly transporting coal and other oil to actually transport increasing volumes from consumer goods, cars, and chemicals. And actually e-commerce has been driving a lot of their volumes. So they mainly compete with the trucking industry, especially for intermodal transport. So intermodal transport is actually the transport that because if you, let's say you do ocean shipping from the port, you have to ship to a door, the consumer's door. Last time you had to unpack the containers, then load it on the truck. Then the truck might ship it to the consumers. But that's actually very time consuming and inefficient and cost more because you have to unload the containers. So intermodal containers are actually those that, so now they build the tracks all the way to the port. So they can unload the container straight from the ship onto the railroads. And they bring the railroads straight to the terminals nearest to the consumer. And the last mile is delivered using trucks. So they actually save a lot of time because they don't have to unpack the containers, and they increase a lot of efficiencies and reduce the lead times for shipping. So this has actually increased to about 42% of revenues for US freight. Historically has been a lot from coal, but now it's mainly intermodal transport. So that's actually their next growth driver. So you can see that intermodal traffic has been increasing. And currently, actually, in the inflation environment with high oil prices, shipping by rail is much cheaper per ton mile because I think each rail can carry about 20 times the amount of one truck or something. So basically, truck is more fuel, they consume much more fuel per mile compared to rail. So it's cheaper to transport by rail and more efficient for the climate, lower fuel intensity and stuff. So actually in periods of high oil prices, I think railroads have performed quite well. So I think when I checked, I think 1 month ago or something, their stock price was flat on the year when the market was down 20%. So it's actually quite interesting. They're basically quite a stable stock to own, and even during high oil prices, inflation, I think they will do well because even though fuel is one of their big cost drivers, but I think for the trucking industry is much larger. So if consumers have only two choices of using trucks to transport or freight or railroads, they definitely will choose the railroads because of the cheaper prices, especially over long distances. So where is railroads going? So there are actually current underlying trends that are pushing the railroads. So one is automation. So autonomous trucks is actually said to possibly reduce trucking costs by 70%. So that will be a huge threat to the railroad industry because it will be much cheaper to ship by trucking. And due to its basically you can reach the last mile delivery. So that's actually very attractive if the goals are hit, but currently I don't think it's there yet. And there are some companies are also investing to automate more of the railroads, and some even have like self-driving trains, which is quite interesting. But I think that wouldn't be coming soon also. So these are some trends. Another trend is also labor. So there's a labor shortage in the trucking industry, and they make up about 27% of jobs in the transportation industry compared to only 3% about railroads. So if you recall, railroads were the largest employer about maybe 100 years ago. So currently only 3% of the transportation industry. And it's hard for railroads to actually achieve more efficiencies because if they automate more of their processes, they have to fire people. And because it's so unionized, right, it's very hard to negotiate to fire more people or even not increase their employee costs by a lot. So that's one headwind that is facing the railroad industry. Of course, there's some tailwinds also, like growth. So freight volumes, according to the Bureau of Transportation Statistics, is expected to increase 50% by 2050. And it's not CAGR, it's just the absolute 50%. So that's not a lot, but I think if you do a CAGR, it's probably also low single digits. That provides some tailwind. At least you know that the industry will just grow over the long term, but not at a high growth rate. Yeah, so I think the last slide will be just a general comp sheet. So this is just to compare. So I think generally, if you look at as I mentioned, the Canadian ones, so they are trading at about 22 times forward PE compared to the US ones at about 15, 16, 17 times. And margins wise, that it might explain some of this because if you look at Canadian Pacific and National, they have about 35% margins. So it's higher than the US players. So that might sort of explain why they're trading at higher PEs. Yeah, so these are ROE, RIC, and ROE. So there's nothing much. If you look at the growth also, CSX is EPS CAGR is higher, but I think in a few years before they made some acquisitions, so that might be distorted by acquisitions. But generally, if you look at their returns, it's just maybe double digit, so low double digits, maybe 10 to 15% EPS CAGR growth. And if you notice, the FCF CAGR is lower because they have to reinvest. So their free cash flow conversion from net income is not 100%, it's I think about 80%. So they are still quite capital intensive. Yeah, so I think that's about it. I mean, can I welcome any questions?
Yeah, okay. Yeah, thank you. That was so detailed, and I've never looked at this industry before, so it's all very new to me, very interesting. Yeah, I think we have time for one or two questions. If anybody has any.
I think I see some questions in the chat. So maybe Shinya, debt level is surprisingly low. I think yeah, so I think their debt levels are also quite regulated. So they cannot take on too much debt. So the government actually regulates how much debt they can take, and they regulate that they should take on some debt, similar to utilities, because it optimizes the cost of capital. So that they also use the WACC to calculate the cost of capital, surprisingly. I mean, yeah. So I think the last number of their cost of capital was about 7.9%. So that's quite low. And some people are arguing that in your DCF calculations, you should use a lower WACC because of the higher certainty of your cash flow. And because the capital intensive nature of it distorts the DCF. So it might not look attractive on the DCF if you do a DCF valuation, but it's because of the high capex. So some people are arguing for a lower WACC, which I think is interesting. I mean, why would you use a lower WACC? I mean, the WACC is the WACC. I think I saw some questions from over here. So, yeah, it's cyclical actually. So the last recession, if you look at the revenue, so in 2008, 2009, the revenues actually came down a lot. It's not that people avoided using railroads, it's just the amount of volume carried is just lower because the economy slowed down, consumer demand slows down, consumer spending slows down. So that results in less goods being carried, and the revenues are a function of the goods carried. So that's just generally that it's really dependent on the GDP.
Yeah.
Hi, Gen Qing.
Yes.
Oh, sorry, I want to share my video. Yeah, well, I think the sector review is very interesting. Good job. I enjoyed, and I especially like it because you start from a history, right? And then it helps people, everyone to get the, kind of a big picture, and then why we are here, I think. Right? And then it is also kind of an indication of, the railroad industry of other countries to some extent as well. So I think this is very helpful. presentations. Have you noticed there's one investor called TCI, or Children's Investment Fund?
Oh, the Chris Hone, is it?
Yeah. So you
Yeah,
should check out because
he has
he's
CP, right?
playing.
CP is largest holding.
Yeah. So he's behind the occasionally 1, 2, or maybe 3 companies, and then he's taking those activists, the campaign. And then one of the reasons the industry was able to consolidate or rationalize because of his involvement as well. And sometimes he opposes the unnecessary consolidation as well. But then it is interesting, like maybe if you follow what he has done over really probably 10, 15 years, and it's not only railroad, but then you can also take a look at the other the portion of his investments, a lot of utility companies that most of people do not think are very attractive industries, but then he has an amazing job on those the investments. So a lot of people are interested in the high growth technology companies, right? But then there's a way for people to invest in those quite boring, almost no change companies, but then you can still generate 15-20% annualized returns quite consistently, like the Chris Hong. So you should definitely if you like these industries, and then you can really avoid Chris Hong or TCI, and then I highly encourage you should take a look, because most of people think, revenue growth 3.5% annually, it's boring, it's not interesting, right? But then that's not really the point, right? What's interesting about the railroad industry is their way of using balance sheet, right? And then using the cash flow to pay back to the investors, right? And then quite often a lot of people misunderstand this, the quality of those businesses, and then they're amazingly strong, the pricing power. Yeah, so it's a good point. I love you're working on this, and then I'd love to see that you explore more and more in those the so-called boring areas.
Yeah.
And there's a good reason for for Buffett to buy, right? Because I think a lot of people are wondering, why he's buying the Burlington Northern. It looks like a very boring and then no promise business. But then I think Burlington Northern is now generating probably 20% of the Berkshire's revenue, or maybe profits, I think.
Yeah, I think about there. I think, let me see. Burlington, EBIT is about 8 billion. Yeah. So Berkshire Hathaway, I think, is about 20 billion a year. So yeah,
that's pretty big, right?
Yeah.
Is that 20 billion EBIT or 20 billion net profits?
I think EBIT is about 25. I can't remember Berkshire's. I think 25 to 30. So yeah, it's about 25.
More than 30%, right?
Yeah. Yeah, I think it's really quite interesting. I mean, he bought at the right time also. So he bought at the right price.
I think if you look at the margin, right? How many companies, how often can you actually find 30% EBIT margin companies?
It's easy to find in 1 year or another, but across the period of time, it's pretty hard to find.
Right.
Yeah. Yeah, it's really interesting. I mean, the margin profile is very stable, and their free cash flow is also very stable. So I think that's what attracts a lot of
and then a lot of people think about the passenger rail, which is terrible business. Terrible.
Yeah, it is.
Right. I don't think anyone is making money on railroad, the passenger rail.
No, so I think worldwide, all passenger railroads are nationalized except for, I think, maybe Amtrak. But Amtrak is losing, I think, hundreds of millions a year. So they need taxpayer funding. Because the consumers control the price. But in a freight railroad, it's not. It's really a lot of contracted price. And yeah, I think if you all of the railroads come together like implicitly to sort of fix the price. I mean, that's your pricing power.
Yeah.
You have
So
no
the
alternative.
biggest challenge for the freight potentially is once the truck the truck the freight truck became all automated.
Yeah.
Right. That's probably one of the biggest costs of the trucking is
it's labor.
It's labor. Right. And the labor becomes zero, then suddenly they become a lot more competitive to railroad, and it's more flexible. So
yeah. So that's one big trend, but I don't know how far out is that.
But I think it's going to be hub and spoke, right? Probably one day maybe Union Pacific probably owns there are a lot of the trucks.
Yeah. So actually, Union Pacific invested in Too Simple, which is autonomous truck. Yeah. So they invested I think 350 million into that. So they're trying to get some skin in the game for the truck side also.
Yeah, maybe they can actually offload the container, right, and then put that into the truck automatically. And if you can actually make it automated and then very quick, then that's pretty powerful.
Yeah, but I don't know about regulation. I mean, if you control the whole chain, I don't know how the regulators react. Plus, Union Pacific is really the largest, so yeah, I think it's pretty hard for them to like do a whole supply chain kind of thing.
But that's why they have to stay in this way, right? And then that's why they have to focus on the truckload, because then they don't violate the antitrust law.
Yeah, but I think their lobbying power is very strong. So I think they have a lot of lobbying firms that help them lobby Congress. So I mean, they also sort of employ quite a lot of people, and they contribute a lot to the state's economy. So I think still they have some power to push back against regulation.
Yeah, but then monopoly is beautiful. Like naturally happening monopoly is a beautiful.
Yes, of course.
Right. So that's why if you look at these margins, right, that's why monopoly is evil. Right.
Yeah.
I think this margin is if you look at the the Amazon, right, the margin is terrible, right? If you look at the net margins, they're growing, but the net margin is terrible. They're not making a lot of money. So yeah, I think this is the very typical I think of value investing. And then it's the price is the P is everybody knows this is a great business, right? So the P is now a little bit higher. It used to be much cheaper.
I was actually surprised. I was surprised that it was at these levels, because I thought it would trade at a single digit, but actually it's much higher because of, I think it's just the certainty of future earnings and the good margins. It's just very predictable. So I think people pay premium for this.
Yeah. That I think people notice partly because of the Chris Hong.
Yeah.
He made a lot of money, and then the people start following the Chris Hong in those companies. So there are a lot of the very interesting utility businesses in Europe as well. And then some of the highway companies in Italy or France, or sometimes the airport is also has a similar characteristics as this. Yeah, so you can expand your scope.
Was it? I think some company, Blackstone or something, they bought the Sydney airport or something. I mean, if you can own an airport, it's really a monopoly.
So so the TCI used to own not own, but then it was probably 10-20% owners of AENA, AENA. So this is Spanish. So the Spain has probably 30-40 the small airports, including the large ones in Barcelona, and then the Madrid. And then but this is a national company that owns almost everything. And then it was national, it was the SOEs, the state-owned enterprise. But then they was sold to the public because it was so mismanaged. And then TCI came in, and then, hey, you guys really screwed. And then the margin is so low, and then they actually fixed a lot. And then if you go to Changi airports, you can buy a lot of things. You can eat food and then spend a lot of money. Right? And the airport is, the passengers are captive audience, captive customers. Right? They have nothing else but spending money. Right? Or, just they have to kill time. Right? And then they're happy to pay, I don't know, $20 sandwich because there's nothing else they can buy. Right? So they're not very price sensitive, and then they are willing to pay. And then, but then, these Spanish airports did nothing. They didn't operate restaurant, they didn't operate those gift shops. So yeah, it was a the pretty amazing story how TCI actually turned around. Okay, I'll stop talking, and then the Rishan wants to ask a question.
I think he asked about profit margin growth year-on-year, scale effect. I think partly it's a more stable pricing environment, so they can manage their pricing. And another part is also scale. So of course, there's economies of scale through the years of consolidation and also optimizing their capital structure and ensuring that they can let the operating leverage kick in. And of course, efficiency. So they upgrade the railroads. Then over time, it will cost less to operate compared to operating those old rails. But yeah, I think partly also monopoly. I mean, especially in the West Coast where BNSF and Union Pacific are the only two Class 1 railroads operating there. I mean, they can say that they don't price fix, but I don't believe it. I mean, definitely shippers, if you're looking to ship, you are just finding these two people who can offer the lower price. I'm pretty sure they fix the price. It's more competitive on the East Coast. So for CSX and Norfolk Southern, because and I think there's just more population there, shorter rail trips, so it's more competitive. So there are some regional rails also in competition. Yeah, but I think Union Pacific is quite interesting, and they're the main competitor to BNSF. And I think some interviews, Warren Buffett said that Union Pacific also performed better than BNSF in some years. Yeah, so it's interesting. I think CP is also interesting. So CP actually bought KCS. I think they announced last year and stuff. So I think maybe Chris Horn is behind it because I think CP is his largest holding. I think Bill Ammon also owns a lot of CP. Yeah, so these activist people are inside. It's probably them pushing them to consolidate. But I think it'll go through because KCS is the smallest player. So their revenue is about 2 billion. CP is not very large also, so it doesn't affect anything. Like their combined revenues are still lower than all the others. Yeah.
So I think you have to be a little bit patient for railroad because sometimes price gets a little bit high. Right, and then when a lot of things really cheap right now, I'm not sure if this is the time to buy railroad. But then railroad becomes cheap time over time because people forget.
Yeah, I agree. So currently, relative is actually above the market, and is relative to other opportunities. I think it's not that attractive for the growth profile, especially compared to other opportunities. But I think if, let's say, a recession kicks in, everyone gets bearish on railroads, then maybe it's time to get in because if you see the historical multiples, it's quite within the range.
Yeah, and they can still grow by the buying back shares. Right, they generate a lot of cash. So
yeah,
so that's that's very powerful. And then in case of the Burlington Northern, they give a lot of cash for Buffett to buy shares right now.
I think one reason why he bought, so he gets real-time economic data. I mean, he says he reads like the weekly reports or monthly reports of how much freight volume is carried. He knows real time how the economy is doing, which is quite interesting. I mean, yeah, and if you think from the angle, he's quite a genius. He bought it. I mean, if he bought at 29 billion, currently I think it should be worth about the same level as Union Pacific. Just a multi-bagger plus. Yeah, it's really quite amazing. A multi-bagger for railroad is even more amazing. I mean, nobody would have thought, right? Yeah. Yeah. Anyway.
So let's wait until those amazing moment. And yeah, we can beat the Warren Buffett.
Any more questions?
Okay.
Anyone?
Yeah. Okay, if not, then I think today's sector review can come to an end. Yeah, thank you so much, Zheng Qing. It was so interesting. Yeah, and
thank you.
Yep. Okay. Bye bye.
Okay.
I
Thanks
think
everyone.
Kai. Yeah.
Bye.
Bye bye.